Welcome to Session 7 of our course, where we'll be exploring market disruptions in financial markets. Market disruptions refer to significant disturbances that impact the normal functioning of financial markets, affecting everything from trading to settlement activities. In this session, we will discuss what causes market disruptions, how they affect the market, and the long-term impacts they can have. Let's start by defining what we mean by market disruptions. What are market disruptions? Market disruptions are events that cause sharp price movements, reduced liquidity, and heightened volatility. These disruptions can take many forms, and they have the potential to throw normal market operations into disarray. Disruptions can be triggered by a variety of factors such as natural disasters, government measures, civil unrest, geopolitical events, cybersecurity threats, or other unforeseen circumstances. These events can severely impact the way financial markets function, sometimes causing delays in settlement, difficulties in executing trades, and even a breakdown in trust between market participants. Why do market disruptions matter? Market disruptions are not only unpredictable but can also affect both trading and settlement processes. When markets experience disruptions, trading may become difficult due to low liquidity, making it hard for buyers and sellers to execute orders at expected prices. Settlement can also be delayed or complicated if market infrastructure is affected, potentially leaving parties without the assets or funds they expect. This can jeopardize the stability and efficiency of financial markets, which are crucial for the functioning of the global economy. When trading volumes decrease, or when liquidity is withdrawn, volatility tends to increase, making the market less predictable and more prone to mispricing. Key point: duration of disruptions. One of the key challenges of market disruptions is that the duration is often uncertain. Some disruptions might last for a few hours or days, while others can continue for weeks, months, or even longer, leading to lasting economic consequences. Long-term impact. The longer a market disruption lasts, the more damaging its impact can be on investor confidence and market operations. Prolonged disruptions can cause a loss of trust in the market, leading investors to pull out, which can worsen the disruption itself and create a vicious cycle. In the following slides, we will explore specific causes of market disruptions, how different market participants react to them, and the role of financial regulators in managing such events. Stay tuned. In this section, we will explore the various causes of market disruptions that can significantly impact the normal functioning of financial markets. These disruptions can be caused by several different factors, ranging from unexpected events to regulatory changes. Let's take a closer look at these causes. 1. Unscheduled non-business days. What are unscheduled non-business days? Unscheduled non-business days occur when unforeseen circumstances lead to the closure of financial markets. Governments may declare non-business days due to emergencies or extreme situations that hinder normal market activities. Examples of unscheduled non-business days: events such as epidemics, civil disorder, severe weather conditions, like hurricanes or floods, or even terrorist attacks can force governments to close financial markets for public safety or operational reasons. For instance, the September 11th attacks in 2001 resulted in a suspension of trading in U.S. financial markets for several days. Impact: the closure of markets disrupts normal trading, and the lack of market activity during such periods leads to price volatility and uncertainty when trading resumes. 2. Regulatory and policy changes. What are regulatory and policy changes? Regulatory changes and sudden policy shifts can have a significant impact on market functioning. These changes are often implemented by governments or financial regulators in response to economic conditions, political agendas, or crisis management. Example: the Malaysian fixed exchange rate, 1997-98 crisis. During the Asian financial crisis in the late 1990s, the Malaysian government implemented a fixed exchange rate for the Malaysian ringgit to curb capital flight and stabilize the currency. This sudden policy shift caused significant disruptions in market expectations and trading activities, particularly in foreign exchange markets. Impact: regulatory changes can disrupt market participants' expectations and lead to increased volatility. Sudden changes in policy may cause confusion, as market participants react to new regulations and shift their positions accordingly. 3. Geopolitical events. What are geopolitical events? Geopolitical events refer to incidents or developments in global politics that have wide-reaching effects on trade, investment flows, and market sentiment. These events can include wars, trade tensions, or international sanctions that alter the dynamics of global commerce. Examples of geopolitical events. Trade wars, like the US-China trade conflict, have the potential to disrupt global trade flows and cause price fluctuations in commodities, currencies, and stocks. Military conflicts or international sanctions can disrupt supply chains, causing shortages or delays in the delivery of goods, which in turn affects market operations and investor sentiment. Impact. Geopolitical events often cause market uncertainty, leading to increased volatility and price fluctuations in global markets. This can affect investments and trade between countries and regions. 4. Natural disasters. What are natural disasters? Natural disasters are catastrophic events caused by natural forces, such as earthquakes, hurricanes, floods, or even pandemics, for example the COVID-19 pandemic. These events can have immediate and long-term effects on economic activities. Examples of natural disasters. The 2004 Indian Ocean tsunami and Hurricane Katrina in 2005 disrupted not only local economies, but also global financial markets, affecting the prices of goods and commodities. Health crises, such as the COVID-19 pandemic, have caused widespread shutdowns of businesses, disruptions in the supply chain, and an economic slowdown across the world. Impact. Natural disasters can bring economic activities to a halt, cause disruptions in trade and supply chains, and create uncertainty in financial markets. Investor sentiment tends to decline during such periods of uncertainty, leading to heightened market volatility. 5. Cybersecurity threats. What are cybersecurity threats? Cybersecurity threats refer to attacks on critical market infrastructure, financial institutions, or exchanges by malicious actors aiming to disrupt operations, steal sensitive data, or cause financial damage. Examples of cybersecurity threats. Cyberattacks targeting stock exchanges, banks, or trading platforms can lead to system outages or the loss of data, severely impacting market activity. For example, a DDoS, distributed denial